Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about all the job reports we got this week and what the Fed might do next. Logan, welcome back to the podcast on a very exciting week.
Exciting week, Jobs Friday, man. The honey badger labor market came out with utter violence today. And, the 10-year yield was at a very key level anyway. So we kind of needed a softer report to push this below this. And the headline was a beat. The wage growth was higher than estimates. And it's interesting this week, like when I take all the data together, it's like very exciting for me because it's kind of reminds me of back in like May of 2021 when there was like a big miss in the jobs report and everybody's like, oh my God, we're not paying anybody to work. I was like, oh my God, we have so much leeway for jobs to, come back. Job openings are going to get to 10 million. We're going to get all the jobs back, but it'll be like September of 2022. And here it's kind of the opposite. The internals of the labor market are getting softer. The job market itself isn't breaking, but it's the exact opposite of, let's say, kind of the 2022 to 2023 data. And you have to take all labor data in total in trend. And we talked about this on the last podcast. There's going to be 2 to 3 reports that are going to be misses. There's going to be 2 to 3 reports that are going to be beats. This is traditional with every single year, whether jobs are being created or lost. But this week, as a whole, it's very interesting because I'm almost at my 159 million job peak data where we should naturally start seeing the labor data slow by itself. But we're seeing internal softness in the other data lines that are key to the Fed. And I think this is the one thing I try to stress in the Friday morning was they asked Jerome Powell, what if the job numbers stay very strong or above estimates? And he said that's not very important to them because the growth rate of inflation fell faster and the labor market was solid in 2023 in terms of headline jobs being printed. But now we're in a different case. So today's focus is to take all the data, all the labor data in Jobs Week and every single thing going out in the future, because this week we got inflation, we got the Fed meeting, all this stuff is coming out next week. So we start to see like where the Fed really wants the labor data to go. And being a Fed's not going to pivot until a labor market break person, it's going to be really fascinating, their verbiage right now.
No, it is. But I have to say, I was so bummed when I saw the news this morning because to me, it just takes the wind out of the sails of what we thought could be some lower rates, right? Do you feel that way, or do you still think that?
The 10-year yield made a really, really aggressive move just since May 29th. So to get another break, right, you're going to need like a softer report. And the labor market isn't breaking, but I always say I focus on the internals more than, let's say, a headline job numbers, and the internals are getting softer. Now, here's a good example. Over the next 12 months, because the labor force has grown, prime age labor force for women, all-time highs because our women kick ass and some of our men are just a bunch of losers trolling the internet. But in this case, you really have to start like really having big prints going out the next 12 to 18 months to not have the unemployment rate not tick up. So in this case, the unemployment rate went up a little bit. The labor force number came down a little bit, but I'm kind of at the point where with my labor data where you really need to start printing like 250 to 300,000 just to keep things at bay with the unemployment rate. And I just don't think we're at that point to where the natural growth rate should slow down. So if the Fed is starting to forecast higher unemployment rates, it's really that now. We're kind of at that point. So I do expect the unemployment rate to go up over the next 12 to 18 months. I don't believe like we're almost like less than 500,000 jobs away from like now naturally, which is slow down. If it isn't slow down, then the labor force or the immigration pool got bigger than any of us imagined, and we're just creating jobs off that. But we should be slowing down in the next few months. And that should, in a sense, take the unemployment rate. But really, it's the other job data lines that the Fed really tracks because they have their own kind of internal model with this.
So, so let's go through this week and talk about those other data lines that they track and what they showed.
Okay, so job openings, of course, that's gone from 12 million down to 8 million. My target for them is 7 million. When they get to 7 million, they'll start sounding more dovish. Okay, so we're not there yet, but we're getting there. Number two, jobless claims ticked up a little bit. Again, we're far from the 323,000 4-week moving average, but I would keep an eye on the 4-week moving average, where I think we bounced off of the low for this cycle, and we just want to keep an eye on that going out in the future, because job openings are falling, right? And then jobless claims, if it starts to rise together, there's your starting the formation of breaking. Remember, the labor market hasn't broken yet, but it's getting softer. So the ADP report is probably the least important jobs data. That came in as a slight miss, but people weigh the BLS jobs Friday number. And again, today's jobs report headline beat estimates. Wage growth was estimated at 3.9%, 4.1. That's the one that's the big kicker. We talked about this last month, that I think some people thought the wage growth number would be a little bit stronger last month because of the California minimum wage increase. But I said maybe that filters in to the next few reports. We have that, I think, part of that to today's data line. But going out in the future, keep the rule. 3% wage growth, job openings at 7 million. Those are like the key things the Fed wants. Job openings are now almost back to pre-COVID, but when we talk about the hires and the quit percentage is pre-COVID already. So the labor market is no longer tight, but it hasn't broken yet. If it breaks, trust me, that 10-year yield, it doesn't wait for the Fed. So when the next Fed meeting happens, we're going to have to see the verbiage of it, because I think to now it's not like May of 2021 where I'm saying, hey, listen, we have a lot of leeway here. We're just going to run the floor, and every recession call you see from now on, it's not going to work. Going out in the future, we have different variables to work with.
So, you said that in May we saw the 10-year yield break lower. We've seen lower mortgage rates just the last couple of weeks. And then, so we're recording this on Friday. The jobs report comes out, 10-year yield goes up. So where do you think we're going to land?
I mean, rates should be a little bit higher, but again, we're not anywhere close to 8% mortgage rates because number one, the spreads are much better this year. And I hearken on the spreads a lot because I thought last year that was the big mortgage story that didn't get a lot of attention. And I still think the spreads is a discussion not familiar with a lot of people. And today, mortgage rates would be 60 basis points higher if we had the worst levels of the spreads last year. And right about now, last year is when the spreads were getting really bad. So as always, Sarah, it could be a lot worse, but I just needed the labor market to soften up. You never want to root for a recession. It's just the history of the Fed trying to do a soft landing is very difficult anyway. But the fact that their key data lines are getting softer on them, the things that they have always focused on, should over the next few months, especially the 12 months, change the discussion, especially the fact that I think the unemployment rate is going to start ticking up, just because I don't think we could create enough jobs going after 159 million non-farm payrolls to keep that going. So if the Fed starts talking about that, it's not necessarily a job loss recession in that front. When they did in 2023, when they targeted a 4.5% unemployment rate, I was like, whoa, no, we're not getting that kind of labor force. So you're forecasting a recession. Now you could have like 12 months of 120,000 jobs being created. The unemployment rate would tick up on that factor alone. So it just gets more interesting now, just kind of like it got interesting in May of 2021 when everybody was really down on the labor market because we had that one big miss. But I think we have leeway here. Here we don't have the leeway now like we did back then.
So we have a Fed meeting next week?
Yes.
So that
on
that
CPI
will be
day too. I think it's on CPI inflation day. So whoa, Nelly. Oh, that's going to be a hot time,
Nerds unite right there. Or
Yeah,
I guess
CPI and the Fed meeting.
that's so funny. It's so funny because when we talk about mortgage rates, and we've gotten some feedback from people who are like, when I try to press you, like, hey, okay, so you don't want to talk specifics, but I want specifics, and we had some people will say like, no, you shouldn't do specifics because we've had other people do so many wrong forecasting for like specific rates, which you will never do. You never. I'm not saying you'll never be wrong. You never do super specifics because that's not the way that you look at the market. So I get that.
Well, you could do ranges. It's like, okay, it's like, here's an example. 2024 forecast, we should be in a range between 7.25 and 5.75. That's where we should be. And the lower the rate needs the labor market to get weaker and weaker. That's kind of how I look at it. I don't believe in what we call rate targeting, mortgage rate targeting, because I don't actually target mortgage rates. I target the 10-year yield. Why, Sarah?
Why among all the things? I don't know why.
What do you mean? The slow dance.
Oh, okay.
What
It could have been a
drives
lot
what
of
drives the
things.
10-year yield? So now that, I mean, I still think that it's so weird for people to think that we had lower mortgage rates with hotter inflation, and I think that was the confusing thing because people just assume it. We did that in the U.S. Bank Event. The first chart we showed, I said, oh, look at here, the growth rate of PCE inflation falling, and look, the 10-year yield went up. And I think I get that, but here it's just labor, labor, labor. So I need to see the internals of the labor market start to soften up, and they have, right? They have. We're getting to a point, but unless you have like a complete collapse in demand, you're not going to get these very high velocity downshifts, but you could get stages. And for me, it's always about connecting the dots. Like I could get there, I could finally start to get there because we're almost at 7 million job openings, right? Wage growth is still kind of 1% above where the Fed really wants it. If they could get 3 to 3.5, we could start having that discussion. They will change themselves. But if the labor market broke, it's very simple. Jobless claims will start taking off. End of story, right? And if you look back in the traditional economic cycles, and I think this is where, like, I'm being a little bit, having fun with this, but to all my stock trader friends, your inverted yield curve is not recessionary unless you lose kind of, residential construction jobs or manufacturing construction jobs. This cycle is very unique, right? We had a backlog. We still have a backlog out there. We're still finishing those apartments and the single family homes. And then we have a lot of manufacturing construction spending going on. So this cycle is a little bit different. So if you're confused why the inverted yield curve hasn't created the recession or the stock market is near all-time highs, just remember, those things are, usually when you see disinflation in inflation data and then jobs going down in a recession, then corporate profits will fall. But with yields up here and that employment still ticking, construction and manufacturing jobs are still, that's not recessionary. I know one of their famous economist people said the recession started in October of 2023, right? So if you believe that to be the case, then you're going to see massive revisions on the GDP and the labor data, right? And you're going to need spending to go down, especially on retail sales or stuff like that, or car sales. So just kind of be careful. And remember, take all the data, take the trend's still going one way, right? And we stick to that. And just remember the BLS Jobs Fridays, there's going to be some beats, there are going to be some misses. You take the trend. The trend matters, right? All these things are going to get revised like crazy. And we're heading toward an area where we weren't in 2021 or 2022 or 2023. But now, kind of in 2024, I'm less than 500,000 away from my 159 million people. And the reason I say this, and this is like one of the key things about the labor data. Assume there is no COVID-19. It never happened. If you take the job trends from February of 2022, 157, 159 million, that's kind of where we should be. So you're just kind of that make-up labor demand. And then whatever is happening in the economy, the growth rate of jobs should naturally slow down. We haven't gotten there yet to my 140 to 165,000 average. That means to me the demand curve is still there, or the labor force growth is being pushed by immigration a little bit more than I thought it would have. but it's getting there, right? There's a pathway where I don't want to do this. Mortgage rates will be here. 6 months later, oh, hi, how you guys doing? Mortgage rates. I don't care about a forecast. I care about teaching people how to get there, right? The ride is more fun than just the final destination.
Unless you're having to lock rates and you're trying to figure out.
I know. Trust me. I get it. I totally get. I remember those days. Jobs Friday, and all of a sudden, the 10-year yield would go vertical, and things would, anybody that was floating would be like, I get it. But my job is to just basically talk on the economic side. That's what I do, right? So no ifs, ands, or favors or anything. If you want to accuse me for being very pro-America, go ahead, please.
I know that's not an insult. Okay, so
please.
the positive story for this year, I think, is inventory. This time last year, we were so desperate for inventory, and now we are at least getting back to some normal levels, depending on the market. So I interviewed Mike Simonson a couple of days ago on this podcast, and he, identified some markets that are back at their 2019 inventory levels. He doesn't think things are crashing, but and we just have more inventory now. So maybe speak to that, what we think we're going to see this week.
It's interesting because we had this discussion about inventory like in the early 1980s of this last week. And people have to remember, we had like 10% plus unemployment rates and 18% inflation or whatever. We had massive inflation, massive unemployment rates. Active inventory in the early 1980s actually rose up to 3 million NAR data. And home prices were pretty much flat back then. Now, it's a little bit of a different story. We're working from such a low level. And 2019 just gets me to the fair playing ground. Like that to me is like those states, Texas, and the others that are out there, they're off the savagely unhealthy housing market because whatever happens with the pricing, it's a much more fair marketplace. So I love those markets just because I always think of housing as something that's going to be here, and too many people chasing too few homes makes inflationary a problem, and that impacts future demand. So that's why I'm a very pro supply person. So any state is like A+ in my book, because I'm not like one of these crazy home price crash people that trolls the internet. Like I'm not worried about that. Now that we're in 2024, hopefully now, right? And I encourage everyone. I know not a lot of people have this data line, but if you look at the history of nominal home price declines, and let me tell everyone, nobody cares about real home prices. I'm just sorry, nobody cares. I get all these crash people. They go, but real home, and nobody cares. All they care about is nominal home prices and total payment.
Okay, wait. So back up. What's the difference between nominal home prices and real home prices?
Well, just real home prices. How I look at it is home prices adjusting to inflation, the equivalence of rent. So in a lot of cases, you don't have nominal home price declines. Like the only time we ever had like real big nominal home price declines since 1942 is the housing bubble crash. In the early 1980s, we had very, very little. But people go, no, it's not that. It's real home prices that matter. It's only the anti-central bank people do this. So there's this, like when I talk about real home prices, I just get this look and people just go, what, and I've been doing this for years, and it's just, nobody cares about real home prices. They care about nominal home prices and payments. That's all that matters to them. But in this case, we had a lot more inventory for decades and decades still. And today, it's not so much of a melt up in the sense, it's just that the massive inflation in a qualified mortgage world we live in impacts demand, like really, like in a negative way. We saw this. It's the third calendar year of the lowest home sales ever. So I just need inventory to get back. And if home prices keep on rising with 2019, that's the marketplace, right? That's fair. But I'm not comfortable being this low. So just like close your eyes for a second and everyone think 336 million people in America, 158 million people working. And at one point in this cycle in 2022, March, we only had 240,000 homes. So the mistake I see a lot of people make is that they think everyone is the median income or lower. They don't consider the dual household income. Hence, they don't understand how do we get near 5 million total home sales last year or even this year. So the inflation is the problem. And the only way to balance that out is supply, right? The supply and demand equilibrium changes. But that was a 47% home price growth since 2020, right? And that's just, again, I set limits for this period. I said, as long as home prices only grew at 23% for years 2020 to 2024, I'm like, we're okay. I remember people like that. Wow, 23%? No way. Everyone's broke.
And we hit that one in like 2 years or
like
something.
2 years. Yeah.
Yeah.
That was the whole savagely unhealthy. We need higher rates. Now that we've had 6 to 8% mortgage rates from the second half of 2022 all the way to here, home prices are still rising year over year. The growth rate is slowing down, has been slowing down recently. Now you understand why supply is so important, why I'm such a supply person, why I want 2019 inventory, because we can't operate this way. We literally can't. And I don't know how much longer rates can stay up here, right? The economy has to be firm, right? So I am relishing every single week that I could get my 11 to 17,000 weekly.
We were so close last week. It was 10,000.
It was close. I'll take it. But we could clearly see the slope of the inventory curve was so much faster in 2022. But again, in 2022, we had the fastest home sale crash ever, right? The monthly prints were just going waterfall down. Here, it's not so much. So it's a slow, I think this is the tediously hard part that people don't like about housing. We're in a normal housing market to a degree. So the data isn't moving as fast as people want. It's not like home sales are crashing, on a year-over-year basis or anything meaningful. And it's not like inventory spiking out of control. So again, credit channels run inventory channels. That's how it works. Since not the Peloponnesian anymore, but since 2010, right? So
I would tell listeners, if you can look at the tracker, it really, the charts that we do on the tracker are so good. Like single family inventory, the chart, it just tells the picture so quickly when you see where we are compared to the last couple of years and where we are compared to 2018, 2017, 2019. It's a picture is worth 1,000 words, because so inventory this week, 604,922. Same week last year, we were at 437,000. The all-time low in inventory was in 2022 at 240,000 total. And active listings for this week in 2015, which you always put in for some context, were 1.1 million. And that's not our numbers. I think that's our numbers. So we are so much better than 2 years ago, better than last year, still far below where we would like to be.
And one of the things that you have to remember, this is all happening with elevated mortgage rates and mortgage demand not really growing. So again, how I try to teach my inventory models are that inventory has a hard time growing when mortgage rates go lower, Sarah.
Whatever.
You know why? Because the younger people who don't provide you a house, they take what is left. So if 70 to 80% of sellers or buyers, you're working with 20 to 30% of homes that are not giving you another buyer to buy another inventory. The first-time home buyer comes in, and millennials are so big that they gobble that up and inventory goes down, right? So this is why I needed inventory to get up there, because once the labor market starts to get really softer and breaks, rates go down, and oh my God, what happens? What is the one sector that is basically trending at the lowest home sales ever? What's going to benefit more? Because the majority, we're about to break 159 million non-farm payroll workers, right? We're going to have the most people working with really good demographics. I'm not talking about a sales boom, but boy, it doesn't take much to move the needle, right? So again, I feel so much better this year than I did last year because we've created that buffer.
We have created that buffer. Well, Logan, exciting week. Maybe too exciting for some people's taste, right? We have another big one coming up next week. We'll keep an eye out. Thanks for sharing your insights, and I look forward to talking to you in a few days.
My pleasure, Sarah.